Hello and welcome. You're watching Big Picture with me, Vishal Dahiya, and today we're going to talk about the regulatory framework for microfinance. Now, keeping in line with the announcement it made in February this year, the Reserve Bank of India has released a consultative document on regulation of microfinance space. Now, this framework is aimed at protecting and empowering the borrowers. Now, household income, as per this consultative document, will be approved by a board-approved policy, and no prepayment penalty and collateral for all microfinance loans has been proposed in this document. Also, this document says that simplified fact sheet on pricing of loans will also be introduced. And this all is aimed at facilitating the borrowers and empowering them as well. We'll try and understand all aspects of this consultative document and what exactly is being done through these proposals to regulate the microfinance space. What impact will it have on the microfinance institutions as well as the borrowers therein? For more on this, we're joined by two distinguished experts. Let me first introduce them to you, beginning with Dr. P. Satish is with us. He is the Executive Director of Sa-Dhan, which is Association of Community Development Finance Institutions, a self-regulatory organization. We're also joined by Mr. A.K. Bhattacharya, Editorial Director of Business Tender. Welcome, both of you gentlemen, to this particular show. Let's start with Mr. A.K. Bhattacharya. Mr. Bhattacharya, if we have to understand not only the entire regulatory framework which is being talked about here, the consultative document which RBI has put in public domain, but also the context behind it, putting this regulatory framework in place as well.
Well, this is the consultative paper which Reserve Bank of India has come out with, and this consultative paper is proposing a new interest rate regulatory system, which hopefully will bring in a more market-based and transparent system for determining what should be the interest rate that microfinance institutions can charge from their borrowers. In brief, what these new regulations proposed in the consultative paper suggest that all microfinance institutions earlier were bound by a set of rules that govern how much they can charge by way of interest. Now, one of the conditions was that the average base interest rate charged by the top 5 commercial banks, and those interest rates, the average rate would be multiplied by 2.75, and then that would be the cap on interest rates. Now, instead of by discarding this, the consultative paper now says that let there be a market-led model wherein each microfinance institution will actually have a kind of an interest rate model published and disclosed upfront for their borrowers to see, and that interest rate model will include elements like cost of funds, margin that they want to charge over interest rate, then this premium so that the borrowers know what is they getting into by the microfinance. Not only that, if there is an inner rate of interest on payment delays, that inner rate of interest has to be paid out by interest. What is actually happening right now is that there is some sort of the new system also capping the payment of interest and repayment of principal up to 50% of a household borrower's income, which means that if a household which is borrowing and if their repayment and interest dues more than 50% of their household income, then the excess and any further loans that household will come under scrutiny or maybe not. So on the whole, the idea is to move towards transparency. The idea is to move towards a market-led system. The idea is to move towards prudence. This will have obvious consequences. It is said that released that the margin for many MFIs, microfinance, offer is also say that some banks which are lending to microfinance borrowers at almost 24%, their interest rate will have to come down because there will be more competition. It will push down the interest rate, which are right now around 19% or so. So we have to see how the new regime plays out and to what extent is actually respond to this new signal. As I said in the beginning, it's a move towards a market-based system, a move towards transparency, and it's a move towards greater prudence.
Okay, indeed, move toward transparency and empowering the consumers, specifically those who are the borrowers here, and a market-based system being put in place. Of course, this is a consultative document there, and suggestions have been sought. Let me bring in Dr. P. Satish here. Dr. Satish, from your point of view, and since several of your organization's suggestions, it seems, have also made way to this consultative document, there are two parts of the question here which I would like to understand, and our viewers would also want a little more elaborate, expression on that. One is, what was the need to bring in, these type of changes when we talk about the entire framework of regulating, microfinance space, and also seemingly the aim is to protect and empower the borrower here. And do you agree with what Mr. AKB was saying, that this will eventually bring down the interest rates?
Thank you for inviting suggestions from our side. The need for a change is because if you look at the context, the first time which Reserve Bank brought out any guidelines for the microfinance sector was in 2011, after certain incidents took place in the state of Andhra Pradesh. And these guidelines were quite elaborate, and at the time, Reserve Bank has introduced a class of institutions called NBFC MFIs, which exclusively catered to microfinance. But from 2011 onwards, a lot has changed in the financial sector environment, as we have seen that in 2015, MFIs Bandhan, and in the next year, MFIs were given finance. What we think is that from 2016-17 onwards, the share of banks and small finance banks in the microfinance entire portfolio that has been going up. Whereas the share of MFIs, NBFC MFIs as well as other MFIs has been coming down. At present, the share of MFIs, pure MFIs, is about 35% of the total portfolio, whereas the remaining is shared by banks as well as small finance banks, and to some extent pure NBFCs. It means that the guidelines which Reserve Bank has formulated in 2011 were now applicable only to 1/3 or less than 1/3 of the entire microfinance space. So what we can say is that when you are regulating and prescribing norms for only less than 1/3 of the an activity, it is quite guidelines. It means that we have to have a relook and see whether the entire sector has to be regulated. So that's the reason why from our side, from the sector, from 2016-17 onwards, we have been bringing it to the notice of Reserve Bank that a larger part is outside the guidelines which Reserve Bank has prescribed. So as such, there is what we can say, there is a non-level playing field as far as the pure MFIs are concerned. So that's the reason why, and even Reserve Bank also, as a central bank of the country, has been toying with the idea of activity-based regulation rather than institution-based regulation.
Okay.
So on these aspects, like who can lend to the microfinance borrowers, what are the interest rate prescriptions, what is the loan limits and all. So these restrictions are only for a small set of institutions which are catering to 30% of the space, whereas the remaining set that's the reason why RBI has come out with this consultation document, and I can say that it has come out after a large discussion which the sector's institutions have been having with RBI from time to time, and many of the suggestions which we have made also has been accepted by RBI. And I can say that the centrality to this entire guidelines, now it is a consultative document. They will be coming based on the inputs. Reserve Bank will come out with guidelines. Is the centrality of the borrower. Now the borrower, when the competition increases, if your guidelines are relatively open and free, then the interest rate to the borrower has to come down. Whereas in the present framework, the interest rates which the MFIs have to charge, around that interest rate, even the interest rates of the banks and SFBs were coalescing. That means a bank which has a cost of funds at 5%, and then NBFC MFIs whose cost of funds can range from 12 to 15%. Both of them were lending at the same rate of 22 or 24%, which was actually the borrower was not getting the benefit of competition. And with these guidelines, to a large extent, the borrower will be able to benefit from the competition, and we expect, since a transparent pricing mechanism has to be framed by each institution, and that has to be shared with the general public as well as the borrowing persons, we expect that the interest rate should come down for the ultimate borrower. Of course, there could be some small and medium institutions, MFIs. There will be some tweaking of their interest rates, a percentage up or down it can go. But ultimately, Reserve Bank has shown that for this entire guidelines, the client or the borrower, it is central to that. And also the issue of indebtedness of a microfinance borrower. Now it has been capped at 50% of the household income, that nothing more than 50% should go towards repayment. That itself is quite a, what we can say, quite a scientific step, in the sense that you're not limiting the number of institutions, or you're not limiting the amount of loan, but you're limiting everything based on the ability of the borrower's household to pay. It's quite a scientific methodology, and I think with these guidelines, if they are in place, I think there will be a greater growth of the sector, entry of more mainstream banks to do the microfinancing. And at the same time, the borrower will have a chance of a wide variety of institutions which can cater to his credit needs.
Okay. Mr. Bhattacharya, I'd like to bring you back in here. And since both of you are pointing out very clearly, and if you give a cursory look at this consultative document, it is pretty much clear that what both of you are saying, pretty much that's the central point of this consultative document, and thereby it'll also be the central point of the guidelines which will come in later from the Reserve Bank of India with regulation of microfinance space. That is the customer, the borrower is the key here, and all these steps being taken are to facilitate, empower, and protect the borrower. A few points which all of you have, both of you have mentioned. There are a few more. They are saying no prepayment penalty will be there. There will be no requirement of collateral as well, and sort of a greater flexibility on repayment frequency for all kind of microfinance loans. These were the key points which were so far missing in the microfinance space, because all lenders were trying to go ahead and frame rules or sort of deal with customers the way they pleased.
Well, you are right. I think what is likely to happen in the microfinance sector is quite interesting, because expectation that there will be more competition in this space, and therefore competition can drive down the cost of money is a legitimate expectation, and it is likely to happen because remember that it is not just a question of disclosure, that you have to disclose your interest rate model to your borrower, wherein you will include the cost of your funds, your margin, and your risk premium, but also that the earlier system, if you have one household or borrower, and if there are more than two microfinance institution is lending to him, there cannot be a third microfinance lending institution, the same borrower, same householder. Now that, to my mind, was a kind of a restriction that did not give the householder an option to look at other microfinance institutions for getting a better rate. So what will now happen is that there will be a different criteria will be introduced, which is that if a householder's total interest liability and principal repayment liability is not more than 50% of that householder's income, then he can go in for a third microfinance institution and can borrow money, and that will itself drive down the interest rate cost, because the microfinance institution will have to face the heat of competition. To my mind, that will bring down the cost of money. So it is not just a question of disclosure, but it is also a question of a structural change by which more microfinance institution can actually tap into the borrower and offer a better interest rate, a better deal, so to say. And I think that will itself act as some sort of a downward pressure on interest rates.
Okay. Dr. Satish, if we have to understand from the consumer's point of view, from the customer's point of view, and looking at all these technical aspects, one, underlying theme here is that now all microfinance lenders will be subject to the same set of rules. That makes things more easier for the customer to go ahead and find out where is the best option for him or her to go ahead and take that loan which he or she might require on a very urgent basis.
Yes, certainly, because previously different set of institutions had different sets of rules, and also different rates of interest, and different types of criteria. So at that time, a borrower also was at a loss as to which type of institution he should approach first for a loan. Now here there is a clear choice, because he can look at the product, he can look at the price, and across the institution he is able to see which is the one which is offering him in the best product and at the best price. So that choice the borrower himself has. And another thing is that since the time period of the loan, that restriction also has been removed. It is easier for the MFIs to cater to the other types of loans which the borrowers at present need, like affordable housing, water and sanitation, renewable energy. These are not exactly classified as income generating loans, and the existing guidelines prevented such funding from the MFIs to their borrowers.
Okay. So clearly, it also means, if we have to look at the larger picture, Dr. Satish, that is that this will further push the case of financial inclusion, overall financial inclusion as well. More people will have, more options, better options to go ahead and cater to their financial needs.
Yeah, certainly, because we would expect, as I was saying, not only MFIs and those banks which are in the microfinance space now, but I would expect a larger number of mainstream banks to set up microfinance verticals and start catering to this segment of populations. RBI's consultative document will result in a more greater financial inclusion in the country, not only in terms of outreach, but in terms of deeper financial inclusion, which includes not just a loan for an income generating activity, but for a host of activities which is required for any common person in India.
Okay, there it is. Thank you so much, Dr. P. Satish and Mr. A.K. Bhattacharya as well for sharing your views and insights on this very important aspect as our panelists were explaining the significance of bringing in regulations to the microfinance sector, and this consultative document which has been released by the Reserve Bank of India recently puts in place all aspects clearly focused on the customer, the borrower, they are in to empower and protect the interests of the consumer, the borrower. And this, as our experts are pointing out, is likely to bring a paradigm shift in the microfinance sector. We'll have to wait and watch as to what exactly will the final guidelines from the RBI on this would be. Till then, keep watching. Thank you.